hear about whole life insurance for the first time and infinite banking, I think, wait, that is way too good to be true. What is the catch? So tell us, Lesley, is there a catch? Is there a risk? What is the downside to leveraging a strategy like this?
I mean, there really is no downside. I mean, I can honestly say maybe not everybody will qualify for a whole life insurance policy, right? To qualify for life insurance, there is a health component to it, right? With all insurance, doesn't matter if it's health insurance, car insurance, life insurance, it's all about transferring risk from you to the insurance company. So from a life insurance perspective, they need to have a good sense of your health, right? If you have maybe a history of health concerns, it doesn't mean that you're not going to get a policy. It just means obviously there's going to be some, they're going to be scrutinizing it, and they may alter how much they might cover you for or something like that, right? But certainly your health status is going to be one factor. Your age is going to be another factor, right? That's why I always encourage people to get insurance as young as possible. I mean, literally a baby 15 days old can get a life insurance policy. And that's usually when you're as healthy as you're ever going to be. So, the younger you are, the more affordable it's going to be, right? Because again, actuarial science, it's not like the roller coaster of the stock market or anything like that. It's what's called actuarial science. That's what's applied. And they are looking at your age. They're looking at, if you're male or female, they're looking at maybe where you live. They're looking at your health, they're looking at your income. All these factors are considered when they decide, will we insure this person and for how much? So again, the older we get, we typically start to develop, more health issues, that kind of thing. So again, it doesn't mean you won't get a policy. It just means it might take a little more scrutiny and it might be a little bit more expensive. So the sooner you start, the better. But that's really the biggest risk, is if you're not able to qualify yourself for a policy. But that doesn't mean that that's the end, right? Because many people who do fall into that category, they can possibly get a policy on their spouse. You can get policy, of course, like I said, on your children. Grandparents can get on their grandkids. So I have some clients who are, they're single, but they are now they can see that they're going to start taking care of their mom, like their mom's going to end up moving in. They can get a policy on their parent. There's lots of different scenarios. So maybe, someone else can, someone who you have an insurable interest in, maybe they can qualify for a policy, and then you can still leverage the strategy.
You mentioned affordability. And I know that's a question that a lot of people have. There's a lot floating out there about whole life insurance is too expensive. Get term life insurance instead. So, and I know all three of us know that that's not necessarily true. So tell us a little bit about how whole life compares with term life.
Sure. So, now, I'm not going to knock term life, because I definitely think there's a time and a place for term life insurance, especially for younger people when they're just starting out in their 20s. They may not be able to afford as much whole life insurance as they would like. However, there are two different types of term life insurance. There's convertible term and non-convertible term. So if you are going to get a term insurance policy, please, please, please get a convertible term policy. What that means is, over time, basically you're going to go through the underwriting process. And once you get that policy, it means that you can convert any portion or all of it into a whole life policy without having to go through the underwriting process again in the future. Okay. So again, this may be a younger person. This may be someone coming out of divorce. This could be just someone who right now financially can't afford larger premium payments for whole life. Many times I will do a combo. I will get them a term policy so they can have kind of maximum coverage, but I will also get them a smaller whole life policy just so that they can get started in building up cash value. But term insurance is very, quote unquote, affordable because, again, if you think of actuarial science, the reason that insurance companies charge so little for term insurance is because the likelihood of you dying in that term, so most people, their term is 10, 20, or 30 years. Most people the likelihood of you dying in that time frame is so low that there's basically so little risk to the insurance company that it's basically a cash cow for them, right? And the latest statistic I heard was like less than 2% of term life insurance policies ever get, filed in a death claim. And, it's not a scam because, like I said, there's a very, legitimate use and need for it, but it's just that most people are not going to die in that time frame. Now, whole life insurance is just that. It is there for your whole life. So that term is, it could be 50 years, it could be 80 years, it could be 90 years, depending on how long or how old you were when you got that policy. But the whole life insurance policies today are in place for 121 years, 121 years. So, if you get the policy when you're 20, 40, 60, it doesn't matter. You will be covered up to age 121. So as you can imagine, the cost to insure a person as the likelihood of them dying is going to increase as they get older. So those costs are factored in throughout the lifetime of that product. So you're going to be paying those premiums that are going to cost more than term, but you're going to be paying those premiums for that period. Now you can have a policy structured to where you might only pay it for 10 years. You might have a policy structured where you pay it up to age 65. But for most investors, I encourage them to get a policy that, where they have premiums scheduled up to age 100. And some people might freak out when I say that, but the reason for that is because particularly if you're an investor, as you have those returns coming in, you need somewhere to put that capital. And that is the best place, like I said, if you want to think of it as a savings account, but that's the best place to park your money so that you can continue to leverage it for future investments and that type of thing. If you have a policy that's structured to where premiums stop after 10 years or stop at age 65 or something like that, you can no longer put additional money in. You can continue to use it, like to leverage it for infinite banking, but you can no longer put more money in. And so oftentimes people find themselves having to get another policy or multiple policies because, they need somewhere to put that cash.